Your model has run 52 times, $2.3 billion in structured credit exposure. Tonight, run 53. One cell in one spreadsheet returns a value that should not be possible. You didn't build this model, but your name is on the file. You start at 85 West Street, or 200 West. The address changes. The building does not. Glass, steel, and the particular silence of a trading floor at 5:47 in the morning. The kind of silence that has weight to it, cost to it, consequence. You are an analyst. That is not a title. It is a sentence. You will work between 80 and 110 hours a week, and you will not complain about this because every other person on your floor is working the same hours, and 3 of them are better than you. Your first assignment is a leveraged buyout model, an LBO. Here is how it actually works. A private equity firm, say KKR or Apollo, wants to acquire a company worth $4 billion. They do not have $4 billion. They use roughly $800 million of their own capital and borrow the remaining $3.2 billion against the assets of the company they are buying. The company being purchased becomes the collateral for the debt used to purchase it. You are financing an acquisition with the acquisition itself. The target firm walks into the transaction already carrying the weight of its own purchase price. Goldman is the arranger. Goldman structures the debt, places it with institutional buyers, pension funds, insurance companies, CLO managers, and takes a fee. On a $4 billion transaction, that arrangement fee might be 1.5 to 2%. That is $60 million. For structuring paper, you build the model that prices that paper. You are 23 years old. The DCF, the discounted cash flow model, is what you use to justify the purchase price. You project the target company's free cash flows over 10 years, select a discount rate that reflects the risk, and then argue, with a straight face in a pitch deck that will be shown to a sovereign wealth fund in Abu Dhabi, that the present value of those future cash flows justifies what your client is paying today. The discount rate is technically objective. In practice, you shade it. Everyone does. The model is not a photograph of reality. It is a negotiation with reality, conducted in Excel at 2 a.m. under fluorescent light. You learn something in your first 6 months that no one will say directly. The most dangerous thing at Goldman Sachs is not failure, it is ambiguity. When a deal goes bad, when the leveraged loan price is below par, when the company you advised goes to restructuring 9 months after close, what matters is not who made the error. What matters is whose name is cleanest when the post-mortem lands on the MD's desk. You learn to document everything. You learn to reply all. You learn that a well-placed email trail is worth more than any amount of actual competence. You get promoted. Associate, then vice president. The title VP at Goldman Sachs is not what it sounds like to civilians. There are thousands of VPs. It means you have survived long enough to stop being disposable and start being useful in a different way. You are no longer the person who builds the model. You are the person who explains the model to the client, to the managing director, to the partner at the sovereign wealth fund who controls a $600 billion pool of capital and has not opened Excel personally since 2008. The relationships are the product now. Information asymmetry is the actual mechanism of power in institutional finance. You know what deal is going to be announced before it is announced. You know which company is in distress before the 8K is filed. You know, because you were sitting in the advisory room, that a major pension fund is about to rotate $12 billion out of fixed income and into infrastructure. That knowledge is not yours to trade on. That is the law. But the law and the architecture of incentive do not always point in the same direction, and you are a human being inside a system that was designed elegantly, deliberately, to blur that line. Goldman Sachs has, at various points in its history, simultaneously advised companies on both sides of the same transaction. During the 2008 financial crisis, the firm held long positions in mortgage-backed securities while helping clients buy those same instruments, and simultaneously held short positions that would pay out if those instruments collapsed. The Senate Permanent Subcommittee on Investigations documented this in 2011. Goldman paid $550 million to settle SEC charges without admitting or denying wrongdoing. $550 million on revenues of $45 billion that year. The math of consequence at this scale is not the same math civilians use. You work on a special purpose vehicle once, an SPV. It is a legal entity that exists solely to isolate risk. A company transfers a pools of assets, receivables, mortgages, lease payments into the SPV. The SPV issues securities backed by those assets. The originating company removes the assets from its balance sheet. The risk does not disappear, it is tranched, repackaged, and redistributed to whoever buys the paper. Goldman earns a fee to structure the vehicle, a fee to rate it, and a fee to place it. The risk itself belongs to someone else now, usually someone who did not fully model it. Managing Director. The title takes, on average, 12 to 14 years. There is no formal pathway. There is a committee. The committee considers your revenue attribution, your client relationships, your reputation inside the firm, and factors you will never be told. People who made MD in year 10 have disappeared from the firm by year 15. People who were passed over 4 times have run divisions. The machine's logic is not always legible from inside the machine. At this level, the numbers you work with move actual things, not prices on a screen, things. You advise on a merger that will close 12 manufacturing plants across the American Midwest, 4,300 jobs, because the synergy analysis in your model says the consolidated entity will be worth $800 million more. That $800 million is real. The 4,300 jobs are also real. You hold both of those facts simultaneously because that is what the work requires. The ability to hold both without flinching, without resolving the tension, is at some level the entire skill.
The ultra-wealthy do not hold wealth the way you hold a savings account. At the managing director level and above, compensation flows into structures. Delaware holding companies, offshore trusts in the Cayman Islands or Jersey, family limited partnerships. These are not tax evasion, they are tax optimization. And the distinction is entirely legal and entirely a function of access to the right counsel. A carried interest structure, the mechanism by which private equity partners pay 20% capital gains tax instead of 37% income tax on their earnings, is written directly into the U.S. tax code. It has survived every administration, left and right, for 40 years. That is not an accident. That is a durable political outcome maintained by people who understand that proximity to capital is its own form of legislation. The firm itself does not age, it does not tire, it does not have a crisis of meaning at 3 a.m. on a Tuesday. You do. That is the fundamental asymmetry, and the one nobody puts in the pitch deck they show you at the campus recruiting event. The institution will absorb your best years, your most precise thinking, your sharpest edges. And when you are done, it will find someone younger and do it again. This is not cynicism. This is the contractual reality of institutional finance. And the people who succeed here are the ones who understand it clearly and proceed anyway. You're standing at the window, 43rd floor. The Hudson is gray today. Below, on the plaza, a cab door opens. Someone gets out, early 20s, dark coat, a leather portfolio under their arm that they have clearly never used before. They look up at the building the way you looked up at the building. The first morning, the 1st January, when the city was frozen and the glass tower seemed to go up forever, and you thought, if I can survive this place, I can survive anything. They are about to run the model for the first time. They will stay until midnight. They will make the same errors you made, learn the same lessons, absorb the same asymmetry, and in 14 years, or 7, or never, they will stand at a window just like this one. The machine does not need you to understand it. It only needs you to run it. But you understand it now. If you want to survive the next level, the private equity floor, the sovereign fund, the shadow architecture that actually moves capital at scale, you need to know how the rest of it works. Subscribe to the channel. The market opens tomorrow. Will you be ready?